Okay, everybody, welcome. Welcome to the Gimbal Financial Weekly Stock Market Update, amongst other things. We get into some other things too. Sometimes we talk about investor psychology. We talk about economics in America on a big picture scale, on a global scale. And other times we just talk about doing life. And so we're glad you're here. Wherever you are in life today, whatever you're doing, I hope that it's the start of a really good day. I know it is here, and I am grateful to be here with you. So, welcome. And as you can see, we've got our usual disclaimer up. And one of the areas I noticed that is not on our disclaimer is anything bond related. We've got the S&P 500 index, the small cap index, the NASDAQ index. But today I'm going to talk a little bit about bonds. And so that's going to be really exciting, right? Okay, so that's enough of our disclaimer there. It's been a good week. I took our son Colton with me up to West Lafayette this week, up to Purdue's campus, which is a gorgeous campus. Being around college life is so energizing. Folks there are optimistic about their future. They're chasing their dreams. And so all of you who are going back to school right now, I just want to encourage you to, you're already making the best of it. But I'm encouraged by you, is what I'm trying to say. And so Colton and I, on our way to West Lafayette, we discovered a couple things. In order to pass the time, we had to come up with something pretty creative because young kids today, they're glued to their phone and not or their Nintendo Switch or whatever. And so your worldview could be greatly affected by the electronics you possess. Your worldview might be limited to the window that you can see only through technology. And so on the way to West Lafayette, we decided to play an old school game, which maybe you've played before. And we counted the colors of cars, semis, trucks going by. We said, hey, you can't choose white. Black was the next big winner, gray, silver, blue, red. But when we started to exhaust the colors, there aren't many orange vehicles out there. A few orange semis, definitely not many purple ones. But it was a great way to just take a look through a different lens and open our eyes and see things for what they really are. So, as you're still developing your worldview and the way that you see things, the way that you look at things through your lens, can just consider stepping back and saying, what if I did it differently today? What if I looked at things differently today? What would that look like? What would you learn? What would you enjoy? So let's take a look at the stock market with that in mind. And like I said, we're going to look at it through a different lens today as well. Let's see. There we go. Okay. So what we're looking at is the Dow Jones. We talked about the Dow Jones last week for a moment. The Dow Jones is simply 30 stocks. It's a view into business through 30 companies. And the creators of the Dow Jones, it's amazing. They have created a way to capture what is going on in business in a very simple view. Most of the time when you're on this show with me and Keith, we look at a daily chart, and we're going to do that. But right now, I've got this cued in to a weekly view. And what does the weekly view do for us? It just extends the range. As you can see, if you look in the bottom left of this, you'll see June 2016. And if you extend all the way over and travel to the right, you see where we are in real time. So this is a weekly view. And way back in late December 2021, the Dow Jones hit a high, and we've been trying to come back to that high ever since. The Dow Jones has been holding up very well compared to the NASDAQ, the tech-oriented index, and the S&P 500, a broader index of 500 stocks. The Dow Jones have been holding up very well even in the last couple of days. And so the Dow Jones, what's it made of? It's made of all those household names that you're familiar with and you've heard of. You could Google what's in the Dow Jones, what stocks are in the Dow Jones, because a stock index is simply a market of stocks. Eye-opening, huh? These stocks make up the index, and the stocks that are in the Dow Jones are what's called blue chip stocks. Now, that's probably not a term that's being used amongst my sons these days, but some of you may be familiar with that term, or you've heard that term, blue chip stocks. And those stocks are simply just household names that have been around a while. They're not out to prove themselves. They're not out to say, hey, look at this great new technology we're bringing. These are just consistent products that have been around a long time. And yeah, they're being refined. Services are being refined, but these are tried and true companies. Now, as you know, just because a stock is a household name doesn't mean it's a great stock. It could be a complete loser. And the winning and losing is often scored by earnings estimates. And Keith is famous for saying, it's not the earnings that makes the news, it's the reaction to the earnings that makes the news. And we are seeing that today. There are two stocks who came out with earnings last night, and both of these you all probably use at the same time. One is a device that you hold in your hand. Maybe you're watching this from that device right now, but Apple came out with news. Amazon came out with news yesterday or last night's close. And they're having opposite reactions. Even though they're in the same technology sector, they're having opposite reactions. So just because something is a household name doesn't mean it's always going to be a great stock to invest in. The company might be great. They might be doing wonderful things in your community. You may have had a wonderful experience working there. Your brother or your dad may have been there, but doesn't mean the stock's always going to be good. So this is the Dow Jones, and this is the weekly view. I like to look at the big picture oftentimes. Over the weekends. I'll study weekly charts. I'm going to switch to a daily here, and you can see it's been pretty good. We gave up a little steam yesterday and the day before, but overall, the big 30 stocks have been doing fairly well. Now let's take a look at a different picture. This is the NASDAQ. And the NASDAQ, what a ride. Look at this run we've had here. Let me get my pen out. There we go. Look at that nice run. Coming off the December year-end lows, almost right at year-end and start of the calendar year. The NASDAQ has been rocking and rolling. This is the primarily tech-driven index. This is also going to have some of my favorite companies in it, like financial tech stocks. I like those. But this has been looking just fantastic. Now, this green line, rarely do we talk about it, but this is a 21-day moving average. And you can see how the stock prices have just hovered right along the 21-day moving average. Well, we tested it this week, and we've closed below the 21-day moving average. It's time for some profit taking, and that's what's happening here. The part that I don't like to see is, if you look down to the bottom right, you'll see where I'm drawing an arrow here. This is the volume, and so this tells us that the number of sellers have really picked up. And I'll show you another chart here I don't normally show, but let's see. Yeah, okay. So don't get overwhelmed. The main thing I want to show you is on the bottom here. Take a look at the bottom. And this just tells us what's moving up and what's moving down. And the amount of stocks making new highs has been moving down on the NASDAQ. Not necessarily a deal breaker for the indice, but we're keeping a close eye. And Keith has his proprietary chart. When he comes back, he'll share that with us. He's got his proprietary chart that shows you the number of stocks hitting new highs and the number of stocks underneath their 200-day moving average. Obviously, to see the stock market going up, it's got to hit new highs. Okay. Lastly, let's take a look at the S&P 500. And as you can see, again, there's this green line, the 21-day, and it's trying to find some support right on it. Guys, I know we're looking at this through a microscope lens, but that's what we do here. We take a look at what the market is giving us, and then we want to get in line with what it is. And so we're well ahead of the 50-day moving average, the red line, and even more so of the black line, the 200-day moving average. To expand our view, again, let's look at the weekly on the S&P 500. It's had a great run. Look at this. Wow, that's been great. And so to expect a little pullback, that's natural. We're going to have pullbacks that come back into maybe the 50-day. And these are times where staying power is really important. That's a look at what's going on inside the stock market. And when we say the stock market, there is no stock market out there. The stock market is a collection of stocks. And so that's why we like to look at the Dow or the S&P or the NASDAQ, because these are indices made up of stocks that reflect the stock market when you hear that on the news. This week has been a news-driven headline week. We've had a lot of political news. We've had news about credit risks. And I want to encourage you to just dive in and take a look at what's real and what you know to be true. And that's why we look at these markets. So I want to explore a market that we rarely talk about with you. We touched on it a little bit last week, and that's the bond market. The Feds have been increasing rates, 11 months or so now, and it's just been like a rocket. Yeah, the rate increases have been going off. And the goal is to get inflation lower. You might remember where there were I bonds that were paying 9% back when CPI was very high, the consumer price index. And now that has backed off a little bit, and the consumer price index has, and it looks like inflation is coming down. However, it's still above the Fed's target. And Powell had said that he's going to get that under control. And so we wouldn't be surprised to see more increases. They could be slower. They might be 0.25%, but we wouldn't be surprised to see that. And so for the person who is a bond investor, this is what needs to be known, is as interest rates go up, bond prices work inversely, and you know that. And so bond prices have been going down. And I'll show you a little note from our friends over at First Trust, if I have that. Let's see. Yeah, here we go. And this is what I want to illustrate. You can find this on First Trust website. These guys are great. They've been good friends to us, helping us stay in tune with what is happening in the market. And so if you look at this graph, basically these are all just different types of bonds going across. But the important thing I want you to see is this par line. When a new bond is issued, it's issued at par, meaning $100. And so anything above means it's trading at a premium. Anything below means it's trading at a discount. And because interest rates have been shooting up, the majority of bonds out there are trading at discounts. And what we could see happening is a continuance of this. is that bonds will stay discounted as long as rates are going up. So it's important to know. Years ago, we would run portfolios based on a Morningstar style box, and that Morningstar style box would have like 9 little boxes that you could spread out your risk and invest in. And that's a strategy that's still used today, and it's a way to diversify your risk. It's been interesting on the bond side. There's just been no hiding. As interest rates have gone up, bond prices have slipped. So for those who are in retirement years, and we've been taught and educated that bonds are safe, Well, as you know, nothing is safe out there. I mean, there is nothing safe. And so just guarding your capital is really important. So let's take a look at bonds and what's going on inside the bond market. And we're going to, like we did with the stock market, we're going to start off we're going to start off with a almost like a hawk's or an eagle's view. And this is the 30-year treasury, if you could buy one of these. Yeah, okay, great. Look at this. Oh my lands. We're on a weekly again. The weekly helps us see where we've been in the past. And what this is showing you is not price. What this is showing you is yield. And so the 30-year, if you could pick one of these up, 4.28%, I believe is what that says, 4.28. Can you imagine owning anything for 30 years? I mean, I don't know. I mean, maybe you've had a car for 30 years, a classic car, or maybe you've had a family heirloom for 30 years plus, but there's not much in life that we own for more than 30 years, let alone, well, I suppose some people own a mortgage for 30 years. But can you imagine saying, yes, this is the investment for me. I know what's going to happen in 30 years. So yeah, this is what's going on. Is it's paying almost a record high here from the last several years. Let's go down the ladder and take a look at a 10-year next. Okay, here is a 10-year. So if you knock 20 years off your investment time horizon or expectation, you're going to get 4.1%. That's interesting, isn't it? That owning something 10 versus 30, you really don't lose a whole lot of yield, do you? And so the yields again have been spiking up and going through the roof, mainly because of government increases on the Federal Reserve. Okay, let's ratchet it down. Let's cut it in half and look at the 5-year. There we go. The 5-year, 4.1 again. And so as we reduce the amount of years, we're not giving up any income. Okay. If we take this to a daily, oh, it's coming back a little bit today. That's probably a good thing. You see that? So it hit a peak here the other day. What day was that? Oops. There we go. About a month ago, hit a peak on the 5-year. Now let's take a look at the closest representation we have. This would be a 13-week. Okay, pretty steady. And you can see a 13-week Treasury bond index. Again, these are indexes. You can't necessarily just go buy these. This helps us paint a picture of what's really going on. So this is the 13-week Treasury bill, 5.25. Okay, so when you've heard the term on the news or wherever you get your market media, you've probably heard the term inverted yield curve. And basically what that means is you're getting more income off the shorter term stuff. And so money markets today are paying close to 5%. Well, money markets are liquid. You could say, hey, Doug, give me my money tomorrow. And money markets have been liquid for years. Now, there are some things that could cause a money market not to be liquid. But money markets are generally kind of like souped up savings accounts, and you can get your money pretty quickly. And so to say, hey, I could get my money pretty quickly at 5% versus going out, 30 years at 4.2, it creates an interesting conversation. And what it probably tells us is that eventually these rate hikes will be done, and the longer term stuff might stay or retreat back to paying higher than the near term stuff. So that's what's going on inside the bond market. And I think that's really important information for you to know, just because the majority of you are excellent savers. It's how you have money to invest, is you've saved money. And so paying attention to the competition that the stock market has is really important. The market's always trying to fight for the best use of your capital. And when interest rates are peaking up and there's more competition today for your money, the stock market has more competition today for your money. It's an interesting picture to know. Some of the other dynamics of change that are happening right now that we've been noticing is oil prices are up. They're up to about $82 a barrel. And a friend of mine in California was saying that they're paying over $5 a gallon for gasoline in California. I don't know what it is here in Indiana, the average, but it's been ticking up. So oil and gas is becoming interesting again. For the first part of this year, it's been all about tech stocks. Everything tech related has just done pretty well. But there could be a shift, and that's what the market does, is it looks for leaders. Unlike an index, when we're looking at stocks, we like to see good earnings. We like to see sales increasing. We like to see the market responding well to those numbers. We like to see new products in motion that are getting traction. And a lot of times we see that on the retail space where there's new introductions and trends. My sons tend to want to spend money on those types of things, whereas maybe some of us we've been there and done that. And so the new trends, we like to see that. We like to see good management of companies. We like to hear the stories and identify with the management and the founders of those companies. And then we like to see those stocks in a good group. And so as the market does begin this rotation, it's going to be really interesting to see what happens with the leaders and if new leadership will emerge. I'm going to go ahead and switch gears to something that you all are very familiar with, and that is the Anchor newsletter. I'll pop one of these up. Okay, so what we're looking at is the June Anchor newsletter, and I don't know what motivated Keith to want to write about this. I just highlighted the whole thing. Let's see. Well, I'd have to erase it now. Sorry, everyone. Maybe I can do this. No, I don't need to sign that. Oh, goodness. My apologies. Well, over here, you see me circling. Do you have a 529 or a better college savings plan? I've got an 18-year-old. We've been putting money into the college 529. Indiana makes it pretty attractive. And other states have these too, but they don't offer the 20% state income tax credit. And so for Indiana plans, if you have a loved one, family or not, that you want to pour into them and create a college fund for them, now is a great time to do it, because Indiana offers a 20% state income tax credit. That's real money. And that credit is based on an increased amount, $7,500 annually. It used to be $5,000. So 5,000 times 20%, you'd get $1,000 off your state income tax bill. Well, now they've ratcheted up, so it's based off 7,500. So you get a $1,500 discount on your state income taxes through Indiana. In addition to this, Keith highlighted that the Secure Act, the Secure Act 2.0, created a new rule where you have some options if you don't use that money for higher education and it's just sitting there. It could be converted over into a Roth IRA. There's some rules on that. Feel free to get with us, but nevertheless, that's something you might bring up in conversation as you hear people saying, yeah, Billy's going to college, or Linda, she's heading out west to start her freshman year. These are conversations that you could have with your loved ones. And with the next newsletter that's coming out, the August newsletter, I printed off black and white here, but Keith highlights how to make money in stocks. And that's this book right here. You've heard us talk about it. William O'Neill, he passed away a couple months ago, and Keith gives a really nice tribute to William O'Neill in this month's newsletter. So, hey, our time is up today, but I just wanted to walk through the markets with you with a stock market update and a bond update. What's happening on Bond Street? But I hope you're well. I hope you enjoy your weekend ahead. And as always, we're here for you, and we want to cheer you on. Okay, so hi and bye from me, Phil, Keith, and Amanda, and we'll catch you guys later. Bye-bye.